Good morning. Welcome to the new episode of Two Graybeards.
Good morning.
Today we'll go through what happened last week, what we expect from next week, and what we think makes sense to do about it in our portfolio. Nick, what did you think happened last week?
Well, it was a pretty quiet week in terms of data, but also a weird week in terms of price action. I don't think we learned anything new. Still, all the data keeps on coming in hotter than expected. And I can't see how the Fed can be especially pleased with that. Certainly, all the real data is surprising on the upside in terms of both prices paid and activity. So I don't think Chair Powell is going to be very pleased about that next week. What
I
did you
agree.
think?
Yeah, I agree. It was an interesting market since the last Fed meeting, and we've been very defensive and remain so, because since the last Fed meeting, two-year notes have fallen significantly, with two-year yields rising fairly dramatically, and future interest rate hikes increasing, and future interest rate cuts decreasing. Stocks have fallen quite a bit, though. On Friday, we had a fairly strong technical bounce. But, I'd sum it up as not much going on last week. But what was interesting to me, and, we like to talk about themes here at Two Graybeards so that we can help you position your portfolio, not just for the week that happened and the week that was, but more that will happen, but more strategically to take advantage of what we think are important long-term trends. And, it seems like since we started, we focused on what had been a cyclical shift and what is now increasingly becoming a secular shift away from a 40 years of deflationary pressures to inflationary pressures. Things that we talked about called, that I label the three Ds, which is deglobalization or onshoring of production, duplication and shortening of supply chains to include our allies instead of our enemies, and domestic energy production and the time and money and energy and effort that's going to take to ensure that each country around the globe has its own source of energy. And as we look at our portfolio, we've had that trend right. It seems to me that that's a trend that we need to focus on. What do you think, Nick?
Absolutely. And I would encourage everyone to have a look at the chart pack and have a look at the charts of what I'm now talking about, because it'll be quite revealing. Just from a pure price action point of view, the best performer in our portfolio is Mexico, EWW, which is up, up over 20% since the beginning of the year. And this, together with the themes of ETA, which is the Defense and Aeronautics portfolio, ETF, seems to be leading the way. And that is something that we also need to think about adding to. What is happening, I think, very simply, is that a lot of companies have decided to abandon just in time. And they are making that clear to their suppliers, who are building stocks. Now, when you build stocks and you abandon just in time before you rebuild the network around you that is needed to produce in future just in time, you need to basically move geographically your current supply chain. And secondly, you need to build up inventory. Inventory needs capital, and capital use decreases your efficiency. And the only way to make up for that reduced efficiency is by jacking up prices to maintain your overall margin. I think that is happening. I think the major US industrial companies are rebuilding their supply chains in friendly countries like Mexico. And if you have a look at where Mexican stocks were a decade ago compared to where they are now, Mexican stocks are 3 times cheaper than they were a decade ago. That is a trend which I think is only at the beginning of a major secular shift. And also the defense contractors and the XLI as a sector in general, and I'm talking about the industrial in the US, are going to far outperform the SPY over the coming decade, I believe.
Interesting. It really does fit our theme that these companies need to make capital investments, which will be more issuance of stocks and bonds, and follow through not only with inventory build, which is the natural first step when you're trying to make a more safe supply chain, but investment in factories and workers and worker training. In the US, there just aren't those workers. So they may have to be sought by in friendly countries. And where the oil industry was, I don't know, call it 3, 4 years ago, with ESG being a factor, but also demand being a factor. There was just not a lot of investment in oil companies, and they appeared to be uninvestable, and were a very small portion of the S&P 500. And now all that's changed with energy being not weaponized, but essentially subject to these supply chain problems. And it seems that the natural place to go isn't energy at this stage, but industrials. And so, yeah, I think that outperformance of these companies and these countries, particularly our friendly ally with workers, is a sensible thing. And inventory build will be the first step, and then capital investment will follow. So, I think that's an excellent way to sort of take advantage of our themes, while the S&P may not go anywhere.
Yes, and it's important to note that this is not our FOMO. So we are not bullish stocks. Nothing has changed from our point of view that the stock market overall, as represented by SPY, here is expensive. That has not changed in the slightest, but there are, as I sort of often say, there's always a bull market somewhere in something. And I think the outperformance of XLI and EWW and ITA will continue for the foreseeable future. And certainly these are sectors that we have to start thinking about adding to on any dip, I would say.
We'll talk about that when we get to what to do about it. There's quite a bit of news next week. We start with the first 2 days are fairly mild, but then on Wednesday we get two survey datas, ADP jobs data and the JOLT survey. The JOLT survey is the survey about how many companies are looking for how many workers. And that's been something that Chair Powell and the Fed has focused on. And, we expect those to still be hot. And then Chairman Powell speaks on Capitol Hill for his semi-annual testimony in front of the Financial Services Committee. What do you think is going to happen there, Nick?
Well, if he wants to send a bearish message to the market, that is an opportunity that he can take. And then if he does that, then he basically neutralizes the doves on the FOMC. It's only if he wants to do that. So I would have thought that any potential surprise from his testimony is going to be on the bearish side. I can't imagine that he is going to be dovish when he speaks on the Hill for Humphrey Hawkins, because I just can't see the upside from that. The data has all been much stronger than expectations, and the Fed keeps on telling us that they're data dependent. So if he needs to follow through, otherwise the market starts losing the Fed starts losing credibility with the market. He should follow through. It achieves two aims. It achieves the fact that the market is not going to move very far away from discounting a possibility of 50 basis points. We are now discounting around 30% probability of a 50-point hike as opposed to a 25 basis point hike. Yeah. I certainly don't think he wants that probability to go back to zero. That achieves nothing good as far as he's concerned. But on the other hand, he will still want to keep the market guessing. So I think he will want, if anything, to make a bearish surprise to the market. That's the
Right,
way I
right.
would play it.
So we're talking about, you know, 2 months ago, or at the end of February, at the beginning of February, the Fed was fairly dovish because the data didn't support any other position. Powell was notable in not offsetting what had been easing financial conditions, and that and his David Rubenstein interview was, fairly dovish. It would be surprising to me. It's possible. Be surprising to me that given the month of data, and who knows, maybe they consider some of that data blips. I certainly do. But given the month of data, I'd be surprised to see something more dovish than the last time he spoke. And he can make news, but he may not. So I think what's important is to watch that testimony. And if he wants to make news, it'll be very, very clear how he will make it. He will make news in a very obvious way with a very specific statement to answer a question that might even be planted with one of the congressmen or senators during the testimony. So we'll be paying attention to that. And then on Friday, we have the non-farm payrolls, which, is interesting, particularly given the 515,000 of added non-farm payroll workers from last month, which surprised the market in a major way. I don't expect anything like that surprise. And frankly, I do think there was probably some fluff in that number, and we might see a downward revision. But I don't think that, maybe I'm wrong. Maybe the labor market has really eased. But
No.
I don't think so. And
Mm.
so even though we might see a revision on what was a hot number in January, and February, is still going to be, no matter what they print, is still going to be positive job growth.
I think there hasn't been a single unemployment number in the past 6 months or longer that has been weaker than the market expected. Every single one has surprised to the upside. It would be a major shock to the market if this number was below expectations. Yes, certainly there can be a revision to some of the fluff from the January report, which came out in early February. But I wouldn't expect the market to react to that. That's almost expected.
Yeah,
But certainly the core of the number for February cannot be weak, because not a single number that came out in February has been weak. They've all been stronger. Therefore, I discount that possibility to the very low probability that the number is weak.
right.
Therefore, I wouldn't expect anything good for the short end of bonds next week, simply because A, we have the possibility of the Fed chairman being hawkish. B, we have auctions. And C, even if he's not hawkish, the auctions need to be discounted enough so they take into consideration the possibility of another hawkish number on Friday. So I don't expect much upside in bonds. As a result, I wouldn't expect a huge amount of upside in equities, even though we have some very strong FOMO out there at the moment.
Sure.
But what I would expect is the strong employment situation to be reflected in outperformance by sectors like we've been talking about, because it's all interconnected, what we are saying. Outperformance in XLI, outperformance in ITA, outperformance in Mexico. These are themes which I think are going to continue for a very long time.
I agree. So on to what we're going to do with the portfolio. So
Okay.
how do you think we should re-rate the portfolio given our strong view?
We obviously have to jack up our holdings of EWW and probably introduce XLI. XLI and ITA have a huge amount of overlap in the amount in the companies that they hold as core holdings. Basically, you're buying Raytheon and Boeing. That is basically what you're doing. But on the other hand, if you look at the charts of those companies, they are so extremely good, and they have a lot of room to catch up with what SPY has been doing for the past few years. I think what we are basically talking about is a move away from the theme of the last decade, which was let's buy QQQ and forget about everything else. And now we're talking about buying industrials as outperformance. How much we jack them up, I don't know. What do you think?
Well, My caution for adding equities is that I'm not particularly bullish equities, and I look at our SPY position, which is now overwritten with a what is it, a 407 call,
Yes,
and think that gosh, if we get lifted on that 407 call and we go down to whatever the percentages of equities, which will be very low, below our minimum, we certainly need to replace it. And at the same time, if the market did fall, we do have still quite a bit of premium left in those calls that we wrote, and that'll hedge some of a downside in SPY. So I look at that position and say, yeah, I'm good with that, but conscious that on the upside, we're going to need to cover something. And I wouldn't reload SPY. So to me, it's a
absolutely.
great idea to buy something that may go up regardless of what SPY does.
Yes, and certainly EWW needs to be a much bigger position. At the moment, it's like 1.5% of the portfolio. I'd triple that without any problems.
Yeah,
I know,
it's had a big run, but you'll show on this Shark Pack. I saw your chart on that. It's still a third, what, a quarter of where it was 10 years ago,
yes,
relative to the S&P. I think this thing has a lot of room to run.
yeah, I certainly think so. I think for someone who has an aggressive portfolio, EWW is an overweight in EWW is a great position to have. We don't have an aggressive portfolio, and therefore we'll just jack it up to something like 4 or 5%.
Sounds good.
And XLI another 4 or 5% matching ITA, so that overall we are at something like 32 or 35% in equities, but really weighted towards these secular themes that we've been talking about since day one, and they have been in our allocation since day one. They are working, they're outperforming, and we want to increase those while still making it clear that we are not bullish equities overall, and we're not bullish things like XLI and QQQ.
XP.
Sorry, not XLI, SPY and QQQ, simply because we think they are overall on the expensive side.
Right.
Uh,
And so I think the only challenge for our listeners would be we're adding equity exposure up to 35% ish. You'll see next week the week after next, you'll see whether we were called away on our SPY position. If so, our allocation will once again be quite defensive, but also in sectors that we think are outperformers. And in the event that the market does fall next week, we'll have a decision to make regarding our exposure, but we think we're hedged on our SPY for a modest sell off. And we can choose to underweight SPY then once the call position expires.
Absolutely. I completely agree. I think it's time to increase the winners and not be fearful of increasing them, but also stepping away from things that I don't think are going to be in the slightest bit interesting, like SPY.
We've gone on a bit today in terms of time. Is there anything to do in bonds or gold?
I certainly at the moment prefer gold to bonds because I this might be short term, but I feel that I could be wrong in this, but I feel that the Fed's determination to get us back to 2% is going to be tested by the markets. There is a lot of talk from a lot of quarters about the Fed not being absolutely anchored at 2%. And, they might let the target slip to something like 2.5 to 3%. I'm not sure that I believe that, but I think the market will test it. And I think gold might be a better performer than bonds in the short term.
So maybe swap a little bit of IEF for gold for the time being. We got out of gold near the top, and maybe it's time to get a higher weighting of that.
I think that is a very low risk option at the moment. I think even if we are wrong, we're not going to lose very much on it. And if we are right, we are going to make much more than we could possibly lose if we are wrong.
Great. Well, thank you for listening to Two Great Beards. Nick will go through the portfolio in a moment.
As always, the updated allocations are both in the Excel sheet on the current allocation page, but also in the broker statement page. And here you have all the statements on the weekly basis, but also here on the monthly basis, so you can see exactly what we're doing. As we told you, we're going to triple the amount of EWW, and we are also going to add some XLI. So we take this equity allocation from 25.4% to somewhere around 35% or just below. On the chart pack page, I have added XLI and XLY over SPY since we talked about them, and we are naturally adding XLI to the portfolio. I think it's important for you to follow these charts and see what we are talking about in a pictorial manner. It's especially important to have a look at EWW over SPY, and it's very interesting to see how far Mexico has lagged the US over the past decade and how much it could catch up now that the fundamentals are there for that catch up to happen. So finally, let's go to the order entry for next week. These are the orders that we are putting in. We are selling IEF to buy GLD, as we spoke about. So we're selling 100 IEF. We have a position of 200, so half that position. And to keep it constant in dollar terms, we're buying 55 shares of GLD. The XLI and EWW we are adding outright, and I will try to finesse those orders. This order I will do at market on the open, so I will buy GLD and sell IEF. But the XLI and EWW I will try to add drip by drip throughout the week and try to finesse it slightly. So don't have a look at these limit levels, they are meaningless. So what we're doing there is we are buying 100 XLI and we are buying an extra 140 of the EWW. And that will take our allocations between XLI and EWW to somewhere around 34% in equities.